If you own your home and you were born before 1970, there is a change that went through Congress this month that you need to understand before your next property tax bill arrives. And I say need to understand because this is not a suggestion. This is not financial advice. This is a change in how your local property tax assessment is calculated based on your age. Congress did not do this quietly. They voted on it. It passed, and the reason you have not heard about it is because it was buried inside a larger spending package that the media covered for entirely different reasons. Nobody pulled this section out and explained what it means for you, so I am going to do that right now. The rules are different depending on whether you were born in the 1940s, the 1950s, or the 1960s, and the group that stands to save the most money is also the group with the shortest window to act. Now I know what some of you are thinking. Property taxes are local. They are set by your county, your city, your school district. Why would Congress have anything to do with your property tax bill? And that is a fair question. Here is the answer. Congress did not change your local tax rate. What Congress changed is the federal framework that determines how your home is assessed and what exemptions you are entitled to based on your age. Your county still sets the rate, but the assessed value your county uses to calculate your bill is now subject to federal caps, freezes, and exemptions that did not exist 6 months ago. These protections are age-based. They are not income-based. They are not means-tested. If you own your home and you fall within the age range, you qualify. That is the change. Here is what I am going to cover. I will walk through what this means for homeowners born in the 1940s first, because that group has the most urgent deadline. Then I will cover homeowners born in the 1950s who have a different set of benefits. Then homeowners born in the 1960s who actually have the longest benefit horizon of all three groups. Stay through all three sections even if only one applies to you, because at the end I will cover one universal filing that applies to all three groups equally. It is a single form that most homeowners have never submitted, and it can trigger every exemption you are owed in one shot. Before we get into the details, if you are a homeowner over 55 and you want to stay informed on every benefit, tax change, and filing deadline that affects your money and your home, subscribe right now and turn on the bell so you do not miss these updates. I cover these changes the week they pass, not months later when the deadline has already gone by. Now, homeowners born in the 1940s. If you were born between 1940 and 1949, you are between 76 and 85 years old right now. You have likely owned your home for decades. You have watched your property tax bill climb year after year, even though your income has not climbed with it. And you are the group that Congress gave the most immediate relief to. There are three provisions that apply specifically to you. The first is the property tax freeze. Many states already had property tax freeze programs for senior homeowners. The problem was that those programs were opt-in. You had to know they existed, find the application, fill it out, and submit it to your county assessor. Most homeowners born in the 1940s never did that. They did not know the program existed. Their county did not send them a letter. Nobody told them. What Congress did is this. They mandated that every state with a property tax freeze program must automatically enroll homeowners born before 1950 who own and occupy their primary residence. You no longer have to find the form, you no longer have to apply. The freeze is automatic. What this means practically is this. Your home's assessed value is now locked at the 2024 level. It does not matter if your county reassesses your neighborhood next year and says your home is worth 30% more. Your assessed value stays where it was. Let me show you what that is worth in dollars. Take a home assessed at $250,000 in a state with a 2.1% effective property tax rate. That homeowner is paying $5,250 a year. Now say the county raises the assessed value by 12% next year, which many counties have been doing. That is a $30,000 increase in assessed value, which adds $630 to the annual bill. Over 3 years, with compounding assessments, that homeowner would pay an extra $1,847 per year compared to the frozen value. That is the money the freeze saves you. $1,847 a year, every year, for as long as you own that home. And I want to be clear about which states this applies to. As of right now, 43 states and the District of Columbia have some form of property tax freeze or deferral program for seniors. If you live in one of those states and you were born before 1950, the automatic enrollment applies to you. If you live in one of the 7 states that does not have a freeze program, the federal mandate requires your state to establish one by January 1st, 2027. That means every homeowner born before 1950 in every state will be covered within the next 18 months. If you are in this age group and you have not received a notice from your county confirming your enrollment, call your county assessor's office this week. Tell them you were born before 1950 and you want written confirmation that your assessed value is frozen at the 2024 level. Ask them to send you that confirmation in writing. If they say they do not have a freeze program yet, ask them for the timeline on implementation. Get a name and a direct number. Follow up in 30 days. The second provision for 1940s homeowners is the expanded homestead exemption. The federal homestead exemption threshold increased from $25,000 to $50,000 of assessed value for homeowners over 75. This is a direct deduction. It comes off the top of your assessed value before the tax rate is applied. So if your home is assessed at $250,000 and you claim the full $50,000 exemption, your tax is calculated on $200,000 instead. At a typical mill rate, that saves you between $525 and $1,050 per year, depending on where you live. The form to file is at your county assessor's office. It is called the Homestead Exemption Application, and you need to update it if you previously filed under the old $25,000 threshold. Call your county assessor and tell them you want to refile under the expanded federal threshold. If you never filed a homestead exemption at all, you have been leaving money on the table for years. Under the old threshold, that was $25,000 off your assessed value. Under the new threshold, it is $50,000. At a 2% tax rate, that is $1,000 per year you have been overpaying. 5 years of missed homestead exemption at the new rate is $5,000 gone. You cannot get that back. But you can stop the bleeding today. Do this now. Do not wait for your next bill. The third provision for 1940s homeowners is the reverse mortgage protection. If you are over 76 and you have a reverse mortgage, there is a new federal provision that protects you during benefit review periods. Here is the situation this addresses. Many homeowners born in the 1940s took out reverse mortgages and also receive VA benefits. When the VA reviews your benefits, there can be a period where your benefit payments are paused or reduced. During that review period, some reverse mortgage lenders were initiating foreclosure proceedings because the homeowner's income dropped below the loan's occupancy requirements. Congress put a stop to that. The new provision prohibits reverse mortgage lenders from initiating foreclosure on any homeowner over 76 during an active federal benefit review period. This applies to VA benefit reviews, Social Security disability reviews, and pension recalculations. If you have a reverse mortgage and you have a pending benefit review of any kind, here is what you do. Send written notice to your loan servicer. In that letter, state your name, your loan number, your date of birth, and cite the new senior homeowner protection provision. Request written confirmation that no foreclosure action will be taken during your review period. Send this letter certified mail. Keep the receipt. Do this within the next 30 days. Now, homeowners born in the 1950s. If you were born between 1950 and 1959, you are between 66 and 75 years old. Many of you are recently retired or within a few years of retirement. Your home is likely your largest asset, and your property tax bill has been growing faster than your retirement income. Congress addressed this with 3 separate provisions. The first is the assessment cap. This is the single most valuable provision for 1950s homeowners. Congress set a 3% annual cap on assessment increases for primary residences owned by homeowners between the ages of 66 and 75. To understand why this matters, you need to know what has been happening without the cap. In many counties across the country, assessed values have been increasing by 8 to 15% per year. If you own a home assessed at $300,000 and your county increases that value by 10%, your assessed value jumps to $330,000. The next year, another 10% takes it to $363,000. In just 2 years, your assessed value has grown by $63,000. Under the new 3% cap, that same home goes from $300,000 to $309,000 in year 1 and $318,270 in year 2. The difference after 2 years is $44,730 in assessed value. At a mill rate between 2 and 3%, that saves you between $126 and $189 in annual tax savings, and that gap widens every single year because the cap compounds. Over 5 years, the savings grow to over $1,000 per year. Over 10 years, it can exceed $3,000 per year. Let me say that differently so it is absolutely clear. If you do nothing and let your county assess you at 10% per year for the next 10 years, your $300,000 home will be assessed at over $778,000. Under the 3% cap, that same home will be assessed at approximately $403,000. That is a $375,000 difference in assessed value. At a 2% tax rate, you would be paying $7,500 more per year in property taxes than you should be. That is not a small number. That is a second mortgage payment. And here's the part that most people miss. The cap is retroactive to January 2026. If your county already applied a higher increase to your 2026 assessed value, you are entitled to a correction. To claim this, you need to file Form 1098-SR, which stands for Senior Residence Assessment Cap Request with your county assessor. The filing deadline is October 15th, 2026. That is less than 3 months from now. Do not wait. Download Form 1098-SR from your county assessor's website or call their office and request it. Fill it out, submit it. If your county already assessed you above 3% for 2026, you will receive a corrected bill. The second provision for 1950s homeowners is the school tax exemption. If you are over 65 and you receive Social Security benefits, you now qualify for a school district tax exemption of up to $10,000 in assessed value. This stacks on top of the Homestead exemption. It does not replace it. You get both. Here is why this matters more than it sounds. In states like Texas, Georgia, and South Carolina, school district taxes make up 40 to 60% of your total property tax bill. A $10,000 exemption on the school tax portion saves you between $400 and $600 per year, depending on your local school district tax rate. To claim this, contact your county assessor and ask for the Senior School Tax Exemption application. You will need a copy of your Social Security benefit statement, which you can download from ssa.gov. File the exemption application with your county assessor. In most counties, once you file this, it renews automatically each year. The third provision for 1950s homeowners is the expanded capital gains exclusion. You already know that when you sell your primary residence, the first $250,000 in capital gains is excluded from federal income tax if you are single, or the first $500,000 if you are married filing jointly. That has been the law for years. What changed is this. Congress added a $100,000 senior supplement to that exclusion for sellers between the ages of 66 and 75 who have owned their home for 20 years or more. That means if you are single, your exclusion is now $350,000. If you are married, it is $600,000. This matters because many of you bought your homes in the 1980s or 1990s for $100,000 to $200,000, and those homes are now worth $500,000 to $800,000. The gains have outpaced the old exclusion. The new supplement closes that gap. Here is an example. Say you bought your home in 1990 for $120,000. It is now worth $620,000. Your capital gain is $500,000. Under the old rules, a single filer would exclude $250,000 and owe federal capital gains tax on the remaining $250,000. At a 15% long-term capital gains rate, that is $37,500 in federal tax. Under the new rules with the senior supplement, a single filer excludes $350,000 and owes tax on only $150,000. At the same rate, that is $22,500. The supplement saved you $15,000 on one transaction. If you are considering selling your home in the next few years, talk to your tax preparer about the senior supplement. Make sure they apply it when they file your return. The supplement is claimed on Schedule D of Form 1040, and it requires proof of ownership duration, which is your deed or closing documents from your original purchase. Now, homeowners born in the 1960s. If you were born between 1960 and 1969, you are between 56 and 65 years old. You are either approaching retirement or you just entered it. Your home may still have a mortgage. Your property taxes are a significant line item in your monthly budget, and Congress gave your group the longest benefit horizon of any of the three. There are three provisions that apply to you. The first is the Deferred Payment Program. Congress created a brand new federal property tax deferral for homeowners between the ages of 60 and 65 who are within 5 years of their plan's retirement date. Here is how it works. You apply through your county assessor to defer your annual property tax payment. The deferred amount is not forgiven. You still owe it. But instead of paying it now out of your pre-retirement income, the balance accrues at 2.5% simple interest and becomes due when you sell the home or upon your death, at which point it is paid from the estate. Compare this to what happens if you do not pay your property taxes on time without the deferral program. Most counties charge penalty rates of 8 to 12%. Some counties begin lien proceedings within 12 months. The deferral program replaces that penalty structure with a 2.5% simple interest rate, which is lower than inflation. What this means practically is this. Say your annual property tax bill is $4,000. Over 5 years, you defer a total of $20,000. At 2.5% simple interest, the total interest over those 5 years is $2,500. Your total obligation at the end of 5 years is $22,500. Now compare that to paying $4,000 per year out of your retirement savings, which could be earning 5% in a conservative bond fund. The opportunity cost of pulling that money out of savings over 5 years is approximately $5,000 in lost returns. The net benefit of deferring instead of paying is approximately $1,250 over the 5-year period. Plus, you maintain a larger cash reserve during the years when your income is transitioning from employment to retirement. To enroll, contact your county assessor and request the federal property tax deferral application. You will need to provide proof of age, proof of home ownership, and a signed statement of your planned retirement date. File this before your next property tax due date. And understand this, the deferral does not affect your credit score. It does not create a lien on your home in the traditional sense. It creates a deferred obligation that is settled at sale. Your home remains fully yours. You can refinance, you can make improvements, you can leave it to your heirs who would settle the deferred balance from the proceeds. This is not a debt trap. It is a cash flow tool for the 5-year window before retirement when your expenses are high and your income is about to change. The second provision for 1960s homeowners is the renovation tax credit. This is a new 15% tax credit for aging in place home modifications. Not a deduction, a credit. That means it comes directly off your tax bill dollar for dollar. Here is what qualifies. Grab bars in bathrooms, walk-in tubs or roll-in showers, wheelchair ramps, widen doorways, stair lifts, non-slip flooring, lever-style door handles replacing round knobs, first floor bedroom and bathroom additions. These are modifications designed to let you stay in your home safely as you age instead of moving to assisted living or a nursing home. The maximum credit is $7,500, calculated as 15% of up to $50,000 in qualifying modifications. Let me put this in perspective. The average cost of assisted living in the United States is $4,500 per month. That is $54,000 per year. A $50,000 home modification that lets you stay in your home for even one extra year saves you $4,000 after the credit, and potentially hundreds of thousands of dollars over a decade. The credit is available to homeowners between 60 and 65 who make qualifying modifications to their primary residence. You claim it on Schedule R of your Form 1040 when you file your federal income tax return. Keep all receipts. Keep all contractor invoices. Take before and after photos of every modification. You will need a contractor statement confirming that the modifications meet aging in place standards, which any licensed contractor familiar with ADA requirements can provide. The credit applies to modifications completed between January 1st, 2026 and December 31st, 2028. If you are planning any bathroom or accessibility upgrades in the next 2 years, do them now. The third provision for 1960s homeowners is the downsizing incentive. Congress created a one-time $5,000 federal tax credit for homeowners between 60 and 65 who sell a home valued over $400,000 and purchase a replacement home valued under $300,000. The purpose of this credit is straightforward. Congress wants to free up housing inventory. Homes valued over $400,000 are in high demand from younger families. Homes valued under $300,000 are more appropriate for retirees who no longer need 4 bedrooms, a large yard, and a 2-car garage. The $5,000 credit is available once per taxpayer. It applies to transactions completed between January 1st, 2026 and December 31st, 2028. To claim it, you file Form 5405-S, the Senior Downsizing Credit Form, with your federal tax return for the year the purchase closes. You will need the settlement statements from both the sale and the purchase showing the respective values. What this means practically is this. If you have been thinking about selling your larger home and moving to something smaller, easier to maintain, and less expensive, Congress is now paying you $5,000 to do it. Combined with the expanded capital gains exclusion I covered for 1950s homeowners, and combined with the assessment cap and school tax exemptions that will apply to your new, lower valued home, the total savings from downsizing can exceed $15,000 in the first year alone. If you are on the fence about downsizing, run the numbers. Add up the property tax savings on the smaller home, the capital gains exclusion on the sale, the $5,000 credit, and the reduced maintenance costs. For most homeowners in this age group, the math is overwhelmingly in favor of making the move. And here is something else to consider. A $300,000 home in most markets means lower property taxes, lower insurance, lower utility bills, and lower maintenance costs. The average homeowner who downsizes from a $400,000 home to a $300,000 home saves between $6,000 and $9,000 per year in total housing costs before the tax credit. Over 10 years of retirement, that is $60,000 to $90,000 in savings. That is money that stays in your retirement accounts earning returns instead of going out the door every month. Now here is the filing that applies to all three groups. Whether you were born in the 1940s, the 1950s, or the 1960s, this one form is the single most important action you can take after watching this video. It is called the Senior Homeowner Tax Review Request. Most homeowners over 55 have never filed one. Most homeowners over 55 have never even heard of it, and that is by design. Here is what it is and why it matters. In 2024, Congress mandated that every county assessor's office in the country must accept and respond to a senior homeowner tax review request from any homeowner aged 55 or older. When you file this form, your county assessor is required by federal law to conduct a comprehensive review of every exemption, freeze, cap, credit, and deduction you are eligible for based on your age, your income, your homeownership status, and your veteran status. They must respond to you in writing within 60 days. That response must include a complete list of every program you qualify for, the dollar amount of each benefit, and the specific forms you need to file to claim each one. The review is free. The form takes about 10 minutes to complete, and the reason most homeowners have never filed it is simple. Counties save money when you do not claim your exemptions. Every exemption you leave on the table is revenue they keep. They are not going to send you a letter telling you that you are overpaying. They are not going to call you and say you qualify for a freeze you never applied for. That is not how it works. You have to ask. This form is how you ask. Here is exactly what to do. Go to your county assessor's website. Search for Senior Homeowner Tax Review Request. In most counties, the form is available as a downloadable PDF. Fill in your name, your address, your date of birth, and your property parcel number, which is on your most recent property tax statement. Sign it and submit it. If the form is not available on the website, call your county assessor's office and request it by name. Say these exact words. I am requesting a Senior Homeowner Tax Review Request form as mandated by federal law. They will know what you are talking about. They are required to provide it. Once you submit the form, mark your calendar for 60 days. If you do not receive a written response within that window, call back and reference your submission date. They are federally required to respond. Do not let this slip. Every year you do not file this form is a year you may be paying property taxes that are higher than what you legally owe. If you qualify for 3 exemptions worth a combined $1,200 per year and you have gone 5 years without claiming them, that is $6,000 you have overpaid. That money does not come back. But you can stop the overpayment starting now. And here's the other thing about this form that people do not realize. Once you have the written response from your county, you have a document in your hand that tells you exactly which forms to file and exactly what each one is worth. You do not have to research anything. You do not have to guess which programs apply to you. All you have to do is file the forms they list in their response. This form is the master key. Let me bring this all together. If you were born in the 1940s, you have 3 action items. First, call your county assessor and confirm that your assessed value is frozen at the 2024 level under the automatic enrollment provision. Second, refile your homestead exemption under the new $50,000 threshold. Third, if you have a reverse mortgage and a pending benefit review, send certified written notice to your loan servicer citing the Senior Homeowner Protection provision. Your combined annual savings from these 3 actions can exceed $3,000 per year. If you were born in the 1950s, you have 3 action items. First, download and file Form 1098-SR with your county assessor before October 15th, 2026 to lock in the 3% assessment cap. This is the most time-sensitive action for your group. Second, apply for the school tax exemption by filing the Senior School Tax Exemption application with your county assessor. Third, if you are planning to sell your home, talk to your tax preparer about the $100,000 senior supplement to the capital gains exclusion and make sure it is applied on Schedule D of Form 1040. Your combined annual savings from the assessment cap and school tax exemption alone can exceed $700 per year, growing every year the cap is in effect. If you were born in the 1960s, you have 3 action items. First, if you are within 5 years of retirement, contact your county assessor about the federal property tax deferral application to defer your property tax payments at 2.5% interest instead of paying from retirement savings. Second, if you are planning any aging in place modifications to your home, do them before December 31st, 2028 and claim the 15% credit on Schedule R of Form 1040. That is up to $7,500 back on your taxes. Third, if you are considering downsizing from a home over $400,000 to a home under $300,000, file Form 5405-S with your federal return to claim the $5,000 credit. And no matter which decade you were born in, file the Senior Homeowner Tax Review request with your county assessor this week. Not next month, not when you get around to it, this week. That single form triggers a comprehensive review of every property tax benefit you are entitled to. It takes 10 minutes, it costs nothing, and it forces your county to tell you in writing exactly what you are owed. Congress changed property tax rules by age. Now use your age to understand exactly what you are owed and exactly what to file. If this video saved you money or opened your eyes to a benefit you did not know about, hit the subscribe button and turn on notifications. I cover these changes every single week on this channel so you never miss a deadline and you never leave money on the table. Share this video with a homeowner you know who was born before 1970. They need to see this before